When we are looking at macroeconomic indicators, I think one of the things which we bother about the most is the monetary policy. We are very keen to know what RBI might do to interest rates. But when one looks at the role of RBI, there are multiple things that RBI is expected to do. It is not just interest rates. You have stability of the banking system, because RBI is the supervisor of the banking system. You have encouragement to growth, which means that your interest rates are somewhere aligned to ensuring certain stable economic growth, and then inflation being at levels which are low and normal. And you also have an added responsibility in the Indian context of ensuring certain stability in the exchange rate or the a good currency regime. Now, what happens is that the tool with RBI for monetary policy is the interest rate, but this tool's impact on these multiple objectives can be very different. So, when RBI, for example, looks at the GDP numbers and finds that growth has fallen, as has been the case since 2011-12 onwards, when you find that growth has slowed down. Now, ideally RBI would want to have what we call an easy money policy, or a regime where the interest rate is lower, because a lower interest rate will encourage consumption, will encourage investments and bring the growth back. But while keeping those interest rates low, if it finds that inflation is higher, or if it finds that the currency is depreciating, now the responses to these events would be to increase the interest rates. So, there is always this dilemma in terms of trying to balance these four ends, because reducing interest rates might help growth, but might hurt the ability to control inflation. Increasing interest rates to take care of inflation might go ahead and kill growth. A criticism which has been levelled against RBI several times, saying that you have increased interest rates too often. So, while RBI looks at its interest rate policy or its interest rate stance, it has to find out which one to prioritize and how the impact on the other variables will have to be managed.
Yeah, quite right, which is why a good starting point is to look at repo and reverse repo rates over, say, the last decade or so, to see how they have moved. During the boom period, which is from 2004 to 2007, the economy was growing rapidly and banks were lending a great deal too. So, there was a rapid credit growth, and this led to fears that there could be some sort of a credit boom or an asset bubble, which forced the Reserve Bank of India to start increasing interest rates. They did that by increasing the repo rate. The reverse repo rate is linked to the repo rate, it automatically goes up in the same direction. This continued until 2008, when the global financial crisis hit India and the RBI was forced to cut rates. Now, the reason was that, anticipating an economic slowdown, they thought monetary easing would ease the liquidity and allow firms and the government to grow at a somewhat more comfortable pace. The cutting of rates and the easing continued for a long time until inflationary pressures set in. There was a crisis in 2010-11, global food prices rose, oil prices went up and inflation began to hit India. That is when the rates were increased again. So, the interest rate rising cycle continued until the end of December 2011. So, by 2012, growth had dropped sharply, and some part of that drop in growth was probably because of RBI's interest rate hikes in the couple of years before that. So, in April 2012, the RBI switched from managing inflation to managing growth and began to cut interest rates, and rates began to fall. It did not have any immediate impact on growth, but there was a bigger crisis in 2013. Sometime around July, August, there was a huge exodus of funds from the Indian debt markets, partly owing to the US risk of US tapering and partly because of our own building up current account deficit. All that led the rupee dollar exchange rate to depreciate. So, to manage the exchange rate, so now they have switched objectives from growth to managing the exchange rate, RBI had once again to increase the repo rate. So, all these varying objectives that have to be managed by the RBI with only one instrument, the interest rates, makes it very difficult to really predict how interest rates are going to move in the immediate future. So, market watchers constantly track the repo rate, the reverse repo rate and all other interest rates in the market to understand how rates will move.
So, the tool that RBI has really is the repo rate. Ideally, the RBI would have only one rate, like you have the Fed funds rate in the US, there would be only a single rate. But in India, historically, we have had two rates. We have the repo rate and the reverse repo rate. So, market participants look at both of these rates, because the reverse repo rate is the rate at which RBI is willing to borrow money from the market. So, if banks are unable to lend money in the overnight market, whatever surpluses they have, they take it back to RBI, and RBI is willing to borrow that money from them at the reverse repo rate. And if participants are short of money, they can always go to RBI and borrow money from the RBI at the repo rate. In other words, repo rate is the borrowing rate for the system or the lending rate for RBI. Now, these two rates therefore represent what we know in the market as the money market corridor, because broadly, if RBI is willing to lend at the repo rate and borrow at the reverse repo rate, these two rates therefore represent the money market corridor, or money market rates in the system will have to lie between this, because anybody who needs money can borrow it from the RBI at the repo rate, because RBI would want the growth rates to be encouraged, and in order to do that, follow an easy money policy and bring the rates down, which means the repo rate will have to be brought down. But on the other hand, RBI finds that liquidity in the market is very tight already, and exchange rate is rupee is depreciating against the dollar, and it sees the necessity to increase the rates in order to protect the rupee. You will find that an instance is in July 13, where you will find that RBI steps in, places the currency requirement ahead of the other inflation or growth imperatives in the market, and increases the interest rate. Now, RBI has the choice. So, the focus rate is the repo rate, and RBI has the choice of increasing the repo rate. But if it did that, the signal to the market would have been that this easing cycle has been reversed. And though growth rates are lower, RBI is now trying to reverse that and increase the interest rates, which is why RBI brought in the MSF. It placed a quantitative restriction on the repo rate, saying that only a certain percentage of demand and time liabilities can be borrowed with the at the repo rate, and introduced the MSF, which was at a 200 basis point difference, or a 2% higher than the repo rate. Introduced this rate, made money available at this rate, and said that over a period of time, as the currency stabilizes, the MSF rates would be brought down.
So, effectively it shifted the rate from the repo to the MSF, that is became the new money market rate.
Correct. Everybody started asking what the MSF was, because RBI had placed, MSF would not have been important, it was always there. Yes. But market participants virtually got all the money they needed at the repo rate. But since a quantitative restriction was placed on the repo rate, the MSF rate started becoming important. So, from a market perspective, one is always looking at how these rates are responding, or how RBI is modifying these rates. But a modification of these rates will immediately reflect on the money market. But whether it will impact the other rates in the system, is a question of transmission.
So, monetary policy is a two-stage process. Stage 1 is the RBI's game. The RBI can either cut rates or increase rates, and then other participants in the system like banks or institutions take over. So, their job is to transmit the rate change that RBI has made to the rest of the economy. For example, suppose RBI cuts rates because it wants to stimulate growth. A bank would be expected to cut its lending rate and therefore increase the amount of loans it makes to its borrowers. It may not do so, and there can be a couple of reasons for that. First, its own cost of funds may be too high for it to think about cutting its rates. The cost of deposits may be too high. Second, if inflation is high, there is no way in which it can cut deposit rates without affecting the amount of deposits that it collects from retail depositors. So, transmission is not guaranteed. There is no certainty that if RBI changes interest rates, their impact will transmit to the rest of the economy. Another point equally relevant in the context of monetary policy is that even if transmission takes place as RBI expects it to, there will always be a time lag between an actual rate change and its impact on the real economy. So, if interest rates are cut today, it may take 3 to 6 months for consumption and investment to pick up, and a little longer for growth to take off. So, it may be a 1-year cycle from one part of monetary policy action to its final result. So, monetary policy interest rates are not a quick or immediate solution. It is an instrument which operates with a time lag.
But then a market which is hoping to expect what the monetary policy would be or how the future interest rates would be, it becomes then difficult for the market to form expectations, because assume that the market is factoring in the lower growth rate and the inflation projections of RBI and expecting a rate cut to happen. Yes. As was the case, let us say in April, when it was known that RBI would start responding to lower growth rates because inflation seemed to be under control. So, the market had expected a rapid 100 to 150 basis point reduction in interest rate over a 1-year time period beginning from April. But when RBI actually brought in the rate cut in April, RBI simply said that I am front ending the cut, but whether I am going to cut rates any further will depend on how do I see the inflation numbers. The new governor, when he spoke about these rate cuts, even as recent as November, December of 2013, he was saying that he has not paused the rate, or he has not increased or decreased the rate and held it at a level, but he is only waiting for new information on inflation. So, his next monetary policy action will depend on how he sees the inflation numbers. So, what happens in the market therefore is that the market is exposed to 2 or 3 things. One, trying to expect how the policy action will happen, because it does not happen in a certain cycle of easing converting into a cycle of tightening. It tends to have its own
jerky.
There are
movements that are unexpected.
Correct, yes. That is one. And the second thing is that the market also has to anticipate whether there are other considerations. Is the RBI going to bother about inflation rather than growth? Is the RBI going to bother about what is happening in the banking system, the NPAs and the lending and the crunch on the deposit side, or the third thing that the market has to worry about is completely unexpected moves from RBI, like the one that happened in July 2013. Yes. That whole 200 basis came virtually unexpected.
That is the peril of being a global economy. So, we have to also worry about what is happening in the US and what is happening to flows coming from other parts of the world to our emerging economy. So, monetary policy is not straightforward or predictable. There are too many issues to be looked at.
Right. So, expecting a certain directional movement and taking positions based on such directional movement can be very risky when it comes to interest rates.